Well, we are back. This is the Working Title Show with Zach Sams. We are going to have a great show today. We are, it's almost fall. The weather is cooled down, and it's good to be back in the studio. Awesome guest with us today. I have Shawn Givens and Will Givens. Yes, they are related. Shawn's the vice chairman at Colliers International on debt and structured finance, and Will is senior vice president of the same group. Guys, welcome. Thanks for being here.
Thanks for having us.
Thanks, Zach. Appreciate it.
Yeah. Y'all are looking really sharp and fresh today.
Both showered, I think.
I did.
Yep.
I did shower. Yeah. I feel underdressed compared to you two now.
Well, I'm just kind of wearing a golf pullover here.
You golf afterwards?
Yeah. No, I wish.
Well,
I wish. How was y'all's weekend?
Yeah, it was good. A lot of family time. A lot of outside time. Church. All the good stuff.
Yeah.
Yeah.
same. Kids, church, sports.
Rinse and
It's
repeat.
a blur, right?
Yeah.
It's a blur. Then the
Trying
week
to make anything
starts.
fun
You're up
happen.
early and you go.
Nothing.
So, how are things with business? Everybody's, we're in a weird time right now in commercial real estate. How's business going for y'all these days?
You want to start? I mean, to start.
You can start for sure.
We're very busy, but it doesn't always equate to deals, right? So deal flow is not an issue, and I've always found that these are the times you make your best clients,
Right.
in the downturn, because you can't just walk down the street and get a loan. So we're flush with deals. We probably have 108 deals we're quoting actively right now. It's a huge portfolio.
That's awesome.
And some of those are portfolios that make up that amount. But yeah, lending's just tight. Liquidity's tight like it was in '08. So it's a different time for sure.
Yeah, it's I tell people all the time that in the commercial real estate business, everybody wants to they don't really want to know, but maybe it's small talk. They kind of ask you about it, and I say kind of working like 3 times as hard to make less money than I did last year. But
That sounds right.
At the same time,
That feels right for sure.
we're lucky to be in Dallas. Sun Belt, where some deals are still happening. For us, in the title side of the business, the big deals are a lot more few and far between. But we're seeing deal flow, under 20 million, a lot more of that.
Yeah, we're seeing a lot of private clients still transact. Less institutional for sure, though.
Yeah,
That's been the hardest.
I know. So, just for the listeners out there, give us kind of a rundown on what y'all do as debt and structured finance for Colliers International. What are y'all lending on? What y'all's day to day look like?
Loans. We do loans. My kids joke. They said, "Dad, you lend money. Where's all the cash?" They thought I had it at the house somewhere. I said, well, it's not my money.
That's why you're not allowed in the closet.
That's
right.
Yeah,
Yeah.
that's exactly right. But no, commercial real estate financing, and it's really any and all commercial assets. We do a lot of apartments, retail, office, industrial. Less office today,
Sure.
based on the market, but I'd say probably our hot spots right now are retail and apartment.
Have y'all done any office deals this year?
3 weeks ago, we closed one.
We closed one. Yep, we're quoting a few right now. They actually got decent quotes. I think the offices that are still around, that are selling, or on the market, that are occupied well, can get done. Right? 'Cause
Yeah.
they're the ones that have survived this long. If they still have full tenant base, have good tenants in the building as well. Maybe not getting as attractive debt as everyone wants, but you can still get them done.
That's interesting.
Yeah. And those are specifically in DFW, which helps a ton.
How do y'all feel like where we are? And I'll tell you why I'm asking you this in a second. But how do y'all feel like where we are in? I don't know if you want to use the word cycle, but do y'all think that you think we're in the early stages of what we've been experiencing, the slowdown in this year, or do you think it's moving towards stronger activity in let's say the near future, 12 to 18 months?
For me, I think it's weird because our real downturn on our side was probably last December.
Yep.
Really?
And normally fourth quarter is slammed. It's our busiest.
December 22 was
22, December. It just hit a wall.
Yeah.
Those last 3/4 BIP raises from the Fed really, as Shawn said, hit that break hard.
Yeah, all the rate hikes quickly just stalled everything. And so that we had, normally when we see a rate hike cycle, we have 4 to 6 months lull time as sellers adjust to what's the new normal.
right
And there was no way to really adjust to it. Rates just kept shooting up.
every month.
Every month.
Right.
And so we had that, in our industry at least, that 7-month lull. We're very blessed in that we were still closing transactions.
Yeah.
It didn't stop for us, but from 20 deals a month is probably our average, 15, 20, down to 5, 3. A huge drop.
Yep.
Was the December 22 versus today, are the rates, are they very different as far as what y'all are quoting?
Yeah. Yeah, we're probably, I mean, an average deal today is probably in the low sevens.
Okay.
I say average, but it's a moving target. Banks
Yeah, we
are all over
talked
the
about
place.
that. Yeah.
Yeah, but for us, we look at more.
What was it in December 22 though? If it's low sevens now,
As an average,
give
probably
or
low
take.
sixes.
Yeah.
Probably low sixes,
feels
high
right.
fives, somewhere in there. What you also find, though, and this happened in '08, and people always asked why, as the market corrected in 11, 12, 13, right, we saw rates come back in, and then when they go back up a little bit, you didn't quite see that same change to the actual all-in rate for clients. And what had happened in '08 is banks blew spreads out so wide to offset risk that as the rates ebbed and flowed, maybe they were at a 400 spread, 4% over whatever the index is. Well, they had all this room to come in. So if the rates go back up, they're like, okay, I'll charge you 3% over or 250 over. And so that gave a lot of cushion for a while. But what had happened in like 2021, I guess, lenders were getting so aggressive for deals that spreads were 160s on some deals. We did one deal at 109 spread, which is insanely low. But most stuff on a really aggressive deals were 140, 160. Really good deals still were 180 to 200. So I'm saying 1.8 to 2%.
Right.
For everyone listening. And now, I mean, we're pushing 3 from some banks, 2.8. So we're heading back in that flight to caution for lenders. So they just blow spreads out.
Right.
Yeah,
So-
and as they head towards the caution, they also are lending less. So the ones that do blow spreads out, that are still lending, very picky, but
Right.
the majority of them are just on the sidelines. Can't figure out how to lend in this environment, or if they can't figure it out, they just don't want to. They don't want to put a bad loan out.
Right.
Do y'all think have the rate hikes done what the rate hikers is it doing what they wanted it to do, or is it or are we not really seeing what what did they want to do actually, right? They wanted to slow the economy down, supposedly. Is that happening? I mean, it's slowing the commercial real estate economy down.
For sure.
That's
And
for
homes.
sure. And
Home
homes.
transactions slowing way down.
Auto
Right.
loans. Yeah.
Auto loans, yep.
Anything rate focused is slowing down. Again, Texas
Yeah.
is a slight differentiator, right? Because the market's so strong here in DFW. I was talking to a realtor a few weeks ago, and she said the third and second quarter, they sold double the homes over 2 million than they sold first quarter. And people are still buying. People from California, other markets are moving to Texas, selling for 2,000 a foot, and they're thinking 500, 600 a foot's a deal. And so it's pushing prices up here. So there's still buyers here.
Yeah.
I don't know if it did what they wanted, right? That the idea was inflation was out of control. And
Right.
so they're thinking raise the rates, make things too expensive, people will stop buying. But my personal opinion is that they're still dumping all this cash in the economy on the other side. So you're trying to put the fire out here, but you're just pouring fuel over here.
Right.
So you gotta stop the pumping.
I don't know. I mean, I don't think inflation's necessarily calmed down. I mean, I filled my truck up the other day. It was $100 to fill up the truck.
Sure.
That's crazy.
Yeah.
That's really expensive. That hadn't come down. I don't think the rates are affecting gas prices.
No. Do you drive a semi or what kind of
Yeah.
18
No,
wheeler?
yeah. I mean, what else would you drive in Texas?
The Texas thing.
Yeah.
I think the interesting thing, though, is
I'm an
as-
environmentalist, so I drive a semi.
That makes sense.
Yeah.
I think as less loans are being originated, homes, cars, commercial, more loans being paid down
Yeah.
as well. So because there's that kind of input, export, because more cash is being flowed into debt payments, that's helping as well. But that takes a long time, right? To
Right.
see that play out where there's less cash going in versus for new loans. So we'll see how that plays out, because as they're paying loans down, more liquidity is going back to these banks, right?
Right.
Via mortgage payments or car payments or whatever.
So I was reading this morning, Fortune magazine, I think, put this out, and I forget the guy's name. It's not important, but he was saying that he thinks that we're still in the early stages, of a real estate correction. And two things he said. One, by 2030, there'll be 1 billion square feet of office that is being unused, which is interesting. Really sounds like a massive number.
Yeah.
I don't know what it currently is today. They didn't say that part.
Less than $1 billion.
Less than $1 billion. Yeah. Okay. Yeah, I agree with that. So, but the interesting thing was, it said at the end of the pandemic, Americans' savings accounts were at 2.1 trillion. And in March of this year, that number was down to 500 billion. And today, it's 190 billion.
Wow.
Yeah. That makes
Which,
sense.
That feels right.
at 2 trillion, if there's 330 million people in this country, that's like just under $6,500 in people's savings accounts. And then in March, it'd be $575. What do you think's driving that? Why is is that the inflation taking care of that, wiping out people's bank accounts?
I mean, my opinion is, well, it's cost of goods, right? Everything's up. So they
Right.
still, but people, at least in my feeling, when COVID hit, everyone's freaked out. And
Yeah.
so when it's over, they're like, hey, we're free again. We thought we were going to die.
Right.
And so to me, it feels like there's just this carefree attitude still with savings. Hey, you know what? You got to live. We're out in the market. So people just, I'm not saying this is right.
Right.
But my impression is that people just seem like they're just going to spend and just keep going, right? Enjoy whatever lifestyle they want until they can't anymore. I don't know if you looked at the data on the credit card debt, but I think that's back at all-time highs now too.
Yeah.
Yeah.
So household debt's high, savings are low. I mean, it's
Which that's not really helping the inflation issue if everybody's going out and spending, $2.1 trillion over the next 2 years. I mean, that seems counterproductive to inflation, right?
right. Yeah, no one's pulling back.
I think it's just a matter of time, though. I think as we're seeing, right, savings are going down, credit card debt's going up. At some point, that's going to hit ahead, and just it's going to have to slow down and stop.
Yeah.
'Cause
So what do you think
at
that
some
does
point you'll
for the
forget.
commercial real estate market? Does that
Our
does
market
that have an impact?
Our market was hit hard.
Yeah.
Yeah, very hard.
The thing is that people still have cash, right? And they're still buying deals all cash, and a lot of foreign investments coming into the U.S. as well. What I find with our clients, and it's every type of person, athletes, high net worth groups, family offices, you name it, a lot of them are parking cash on the sidelines because they are. In fact, we're refinancing some large portfolios right now to pool liquidity to get ready for a crash. So. While the real estate market did have a huge slowdown in December, it didn't actually crash because people were still buying. So the thinking is, and we are already seeing deals very quietly that are having problems that they don't advertise.
Right.
The owner just says, hey, anybody wants to buy this and take this off our hands for our costs incurred, and they'll just dump it. So you are seeing those deals quietly happen. But I think when you really see the crash hit, that's when these owners, because they learned from '08. Imagine if you had $300-400 million in '08 to buy stuff on floaters. You could have made so much money.
So you're saying that people or some of your clients might be doing these refinances to pull liquidity out, so when values do go down, they're in a position to acquire at that point.
Correct. And a lot of them have said that.
Yeah.
They're getting dry powder ready for that crash. But it's going to take the rest of the market crashing. And I don't know how this cycle will be because it's different because of the amount of cash that was pumped into the economy and the PPP loans and everything else that is feeding this buying frenzy.
Right.
But typically 7 to 9-ish months is when we've seen the stock market follow the real estate market, right? So if our market crashes or stops, then everything kind of goes along. Housing goes down, cars go down. What's been happening? Luxury goods, planes, all those things go down, boats. And then you start to see the stock market after. And so people aren't as scared right now because the market's strong.
Yeah.
So
Okay. You keep hearing about the office thing, right? All these big office buildings in the San Franciscos, the Chicagos, and New Yorks, and probably a lot of the other metros as well. And they talk about all these vacancies, like they're, and it's funny. There's 2 vacancies now. There didn't used to be. There's like, okay, we're leased at 80%, but our actual, real time occupancy, who's actually showing up to the office, is 40%. So now there's 2 rates. It's what we got leased and how many people are actually coming in.
Sure. Right.
So, and there's lots of debt and money inside these huge office buildings, which used to be like the most expensive real estate, right? These big office buildings around. Sure. And so what's the domino effect as these buildings, some of these legacy buildings, some of these big metros that, maybe they're beautiful from the outside, but this flight to quality, or the new buildings are the only office buildings really that people are really jumping into.
Yep.
So what happens when these buildings don't, the actual occupancy goes down, they can't make their, which we've already seen it in San Francisco, I think, where they can't pay. What does that do when all of these big, properties crash and they can't pay and they foreclose? What does that do to the rest of commercial real estate? Does it have an effect? Does that bleed over into multifamily or other assets when that kind of crash happens in one of those asset classes?
I think it depends on the debt programs the crash happens to, right? So a lot of those were done, not all, but a lot of these were done CMBS.
Right.
So yeah, if you're holding paper in a CMBS loan and it crashes and you have a ton of office go under, then yeah, it's a big hit to your portfolio. a lot of the apartments are done agency, Fannie and Freddie, so different pool
Right.
of capital. So I don't think you're going to see the same hit. It's not going to affect those programs. But what the unknown is would be life companies or banks that are holding paper
Right,
on
because
office
they
buildings.
love those type of assets.
Yeah.
When everybody was going to the office, right? It was like that core. They're making 4%, but they're a life company, so it's great.
Right.
Like,
Yeah. So
do
now
life companies go out? Is this that could really affect life insurance, which that could have other
yeah,
effects
and
to it if they start defaulting on those type of assets.
sure. But most life codes you talk to, whoever they are, have a concentration requirement. So say, okay,
They're not over leveraged.
right. Okay, we're 18% office building or
Especially
whatever the
not a
number
life
is.
company. They're always low leverage. So
Yeah, like we're doing a CVS portfolio right now, and they're like, hey, you're pushing us right to our concentration limits on CVS and retail. So they do have limits. So you're not going to have a life co most likely that 80% of their portfolio is office. But yeah, I
Right.
mean, they may take a 15-20% hit, assuming their entire portfolio crashes. I don't know, and I think that's driving. It's a small piece of what's driving banks today to stay liquid or at least pull back on lending because they want to see what's going to happen to what they have on the books now.
I think two things on your office comment and just lending in general. Met with a CMBS specialist that does workouts, and she says she's never been busy in her life. Like just flying to San Francisco or Chicago all the time to do workouts for office specifically, and just for CMBS loans. So they are going south often. It should not be discussed. I think the second thing to discuss as well is bridge lenders, specifically debt funds. They are doing workouts. And they are doing kind of recapitalizations with the same or with a new owner, which is really interesting. So I've heard of a few deals. The owner is out of the country. They own a big portfolio. They're selling off their entire portfolio because the lenders are forcing them to.
Right.
And the lender is doing the new loans with the new buyers at a new basis. So it's pretty interesting what's going on kind of behind the scenes that no one's talking about.
Like, how do you work out, one of these office buildings that's got bad, I mean, the occupancy is bad, and probably the upside probably doesn't look real good. How do they work out, because the value of that building has got to be substantially lower. So are they just taking the prior bank's taking a big hit and they're now putting new debt on it at a new value?
I mean, the first thing, right, is the bank trying to minimize losses. So
Right.
they're going to try. So if they were lucky enough to do a $100 million building, let's say, and the loan was 50%, then they're thinking, okay, if we can get $50 million out of this thing, we're at least made whole. And then the owner loses equity.
Is that pretty standard LTV they do on those type of?
We used to do them at we used to do
yeah.
them at 70%, 65%.
Right.
Higher.
Yeah, higher. So I don't know today. And one of the other issues is as interest rates rise, cap rates also go up, right? Which means values are dropping. So you're going to have lenders that are saying, okay, we need new appraisals. This was again, make up a number, $100 million deal a year and a half ago. Now it's a $85 million deal, whatever it appraises for.
Right.
So you start to see the valuation issues as well, because if they have covenants on certain LTV requirements, they may break those depending on what the new value does. So there's a lot going on with all this.
Yeah.
Well, what we haven't seen though yet, except for one deal we're working on, we haven't seen a lot of value issues.
Even on office?
Yeah, well, any deal we've currently tried to finance, right? So we're not
Right.
financing a lot of office. So I'm assuming if we were, then that might be a hit there. But I think we all kind of expected to see a few deals kind of in our pipeline just hit a wall on the appraisal side, right? They're just not yet. So the one specifically that did was more of a data issue than anything else.
Right.
So that still is curious to me when that's coming. At some point, appraisers will say, hey, like, these are just not worth what you think they are.
Do you all think the
Less so in DFW, though.
right? Sure. Do you all think the office issue is going to have a major impact on our industry as these? Because we don't hear about it as much. Like you said, they're talking about it kind of under wraps, but has enough time gone by that they're reaching terms on the loans of these office things, or are we still further down there? What are the typical terms if you're doing a $100 million office building? How long are they financing this for? 10 years?
A lot were 10.
Yeah.
But if the deal's still stabilized and cash flowing, then it's much easier workout, right?
Right.
Yeah.
It's the ones that are vacant or having occupancy issues. But that'll be interesting. So we're looking at some deals now that are trying to convert from office to multifamily.
Right.
So that could be a play depending on the layout of the building, what the costs are, or a hotel. Again, depends on the layout.
Your basis just has to be so low for those to work, usually. But
Right.
keep going.
So that's just one thing that people are doing. But it'll be interesting to see because what I also found was during COVID, there were so many people hiring and such a labor shortage that employers could not get employees into offices. And I think at one time the prediction was it was like 36 quarters before the offices are stabilized again. So at 9 years. So 2030.
That was CoStar.
I mean,
Yeah.
we'll be at you said a billion vacant. I don't know. But what I do find now is because of where the market's heading, a lot of companies are laying off. You're seeing it more and more, especially big firms.
Yeah.
And I think companies will use this as an opportunity to say, hey, if you want your job, you have to be in the office. And they couldn't do that 6 months ago.
Right.
Right.
So and we see it not just in our firm. Our firms, we're perfect. But in most firms, I would say, I don't know how it is with you guys at KVA, if everyone's in the office or not.
Yeah, pretty much. Pretty much. We want people in the office.
Sure.
You know, I don't know about y'all, but I think that's a healthier environment, you know, where you're collaborating, you're talking, and, you know.
You don't have an environment if they're not in the office, right?
Right.
They're at their house doing their own thing.
I think it's great to have the ability to do that.
Sure.
Right. I mean, one thing when the pandemic, you know, happened and, you know, we were kind of forced to stay home, you know, at different times, you know, we were set up already prior to that to be able to work from home. And that was huge for us. And I think, and that wasn't because we were preparing for a pandemic. I don't think anybody was, but, you know, we were already kind of moving in that hybrid working environment. People were already doing that. And so that was a big save for us. But we got people back as quickly as we could.
It's important. I mean, you know this story. We've really embraced technology too. So our team, we function fine at home. It's very secure. Everything's locked up. But just the camaraderie in the office is so important. Because it's very important for us as we train our team. We're hard on the guys. We want to be good, right? Because our clients expect that. So we spend a lot of time almost like this environment with a speakerphone in the room, and we just have everyone make phone calls for 2-3 hours a day, whoever they have to call, and put them on the spot. It's very good for them.
No kidding. So y'all get in a room and y'all make and
whatever
each
the call
guy
is
makes a call and everybody listens.
Yeah.
We critique it. And
Within reason, right? Some private clients or big clients, we don't do that for.
Right,
But
right.
if we're just calling a lender or if they have to call someone, our client, to get documentation, we make our analysts do it too. And they get nervous at first. But I will tell you, after 6-8 months of it, they can talk in front of anyone, which is key.
Right.
So it's good for them.
That's interesting.
And we lost that at home,
Yeah.
of course.
obviously.
We tried, you know, pulled them into a call, and then they didn't answer, so we still did the call.
Right.
It didn't work great.
Everybody on Zoom.
Right.
All the Zoom stories, yeah.
Yeah, exactly.
Can't stand Zoom.
I don't like Zoom either.
Yeah.
But no, it'll be interesting to see kind of how things progress and if companies are able to force workers back in the office.
Yeah. Well, I guess they have a better leverage point than they did.
Right.
Oh,
One of my favorite stories is when Starbucks, like corporate, they told all their people they had to come back to the office, and all their employees went out and picketed outside their boss's office.
or their store locations,
I
right?
mean, when on earth could you ever have done that before?
No, without losing your
Picket,
job.
yeah.
Yeah.
I'm gonna go picket my boss.
And it's gonna go great.
Yeah,
But I assume you didn't mean the retail locations because you definitely can't do that.
that would
from
be
home.
really funny.
There were a few.
We're
though, I
bursting
saw.
from home
Just
today.
wanted a
Yeah.
coffee. Sorry,
Come to my house.
work from home coffee.
Yeah, I'll make it at home. Yeah.
That's funny.
I don't know.
Yeah, there was an article, some Dallas news station, I can't remember what it was this morning, I read, and the article said there's 28 offices in DFW that have been specifically pointed to convert to multifamily.
Yeah,
I don't know
I think
what
I read that too.
what data they were referring to. Who sent them that data? Is it CoStar? Is it an actual developer that knows the real costs to see if this is even feasible? Because there are a lot of properties where it's not even possible.
Well, the one I read was out of like some, university faculty that put it together out of New York,
Sure.
and I'm like, yeah,
Okay.
right. Y'all done a lot of
They
y'all
know.
done a lot of real estate.
They
deals.
missed a
They
few
probably
things.
developed quite a few offices.
Yeah. I
Yeah,
think they
I'm
have.
sure they're fine.
I'm sure
Yeah,
they missed a few
they got a
things.
team.
Yeah, yeah.
So before we got started, you were telling me that when you were I guess first in the business, you thought I'd always go to my bank. I wouldn't call a mortgage lender. Y'all are mortgage lenders. So would you expand on that? Tell us tell us why calling someone like yourself is better than just walking down the bank and asking for a loan. How do y'all make that process better?
Well, one, we're calling the country, right? Like we're very blessed. Our deal flows nationwide. We work with clients all over, a lot of international clients as well. So, our team is constantly on the phone every day
with banks, life companies, bridge, CMBS, agency, you name it. We're always talking to them. So we have a really good pulse on the market. And I can't tell you how many times I've sat down with a high net worth group or a family office or someone with their whole team, and they're saying, well, my bank is here and you probably can't touch this, but I'll listen. And most times, like the deal we just did, we beat their bank by almost 2%.
Wow.
Like we saved them hundreds of thousands of dollars. And for these high net worth clients, it's jet fuel for these high net worth clients. They can go to Cayman. So it's there's a lot of value to us. And what I've also found is, we'll fight hard for our clients, but a lot of banks will say this is market, right?
Is that just people just wanting to believe that they're banking at the best place and that, they've got, that's why I chose, so they have to be the best. They don't want to possibly think that their bank might not be giving them the best rate. Is that what's falling into that?
Almost all of them say, I've been a customer with this bank for X years. They always take care of me. So I doubt you're going to beat them. And what I found, unfortunately, I'm not saying all banks,
Right.
but what I've seen with a lot of banks is once they feel like they have a client captive, they don't really fight for them anymore.
Yep.
And so we have some high net worth clients that are like, hey, I have my money at this bank. Go ahead and shop it on every deal because it's important to make that bank fight for it. And we have a story of a deal. We did a huge portfolio. It was 180 plus properties.
Wow.
And the client was with a big bank. And the bank said, hey, there's no other options for this portfolio. You only can do full recourse, loans over $200 million. This is all that's out there. Well, then we get the deal. We have a new option for them in 3 or 4 days that kills that quote, like way better cash flow, non-recourse. And their bank's like, oh, we can do that too.
Yep.
Well, you had the thing for years. You
changed quick.
you just took advantage of your client. And so I think with us, we keep those lenders honest. And we'll fight for the client.
I mean,
Clients like that,
I think they made their situation worse by saying that than if they were just like, oh, wow, that's a good deal. You should probably take that.
They did.
Yeah.
Yeah, they backpedaled and then didn't look good.
And
Yeah.
I will tell you too, a lot of banks, it's not like slam bank day, but a lot of banks too on the smaller side just aren't really creative because they're used to looking at just, hey, does it fit in this box or not?
Right.
And we've done so many literally thousands of transactions. And we've seen every possible scenario, I think. You're always learning every day, right? Something
Right.
new, of course.
Yeah.
But you can have 15 of the same tenant and do them probably 15 different ways, depending on the bank or the leverage or, hey, let's get creative with this structure or that structure. So we find a lot of creative ways too that have worked for us that bank people just don't think about.
Right. So I'm doing a deal and I think my bank's the best. And, I start talking to y'all. But if y'all were talking to my bank, knowing what y'all know, y'all might be able to get a better deal out of my own bank than I could because you probably understand the process or,
Probably.
or speak that lingo better than, maybe the client would. Or
And that happens sometimes where
Yeah.
like they'll say, you can call my own bank if you want, call a different branch and see what they give you. So that's pretty interesting.
yeah.
Well,
and
we
it
bring a
comes
lot
out
of Sorry, we bring a lot of clout with us too, though. As a group, if you're doing 800 to $1 billion or more a year in volume, the banks want that volume. Or an individual investor, even depending on how big they are, they still may only buy 1 or 2 deals a year. So to a lender, like, hey, this person's good for a deal or two,
Right.
but our team may be good for 50 deals, 80 deals. We have several banks. We'll give them $100 million and just be like, hey, as much as you can handle, let's go. We'll make it streamlined.
And they'll say
So
stop.
it's, yeah, like, okay, we're full. But that's a big difference too, right? You bring all that deal flow, which you also instantly remove all that deal flow if they don't perform. And so I think it's also that which helps the client as well.
Are there certain institutions that are lending more so than others right now? I know y'all told me banks are kind of slow to lend. Where are y'all finding funds these days or capital?
Agency's still good.
Yep.
So
Still any multifamily, Fannie Freddie.
yeah, those are still good. Banks hit or miss. Their rates are just higher, but a lot of them are just pulled back, right? You may call 50 banks now for 2 term sheets just because 48 pass.
Yep.
And that's just a liquidity thing in the market today. Life companies are still aggressive for the right deal, and their spreads are still decent. And then CMBS will still price certain deals.
There's also a lot of banks out there I don't even think people realize are out there.
True.
Because they're, you see your normal banks on every street corner, and they've got a drive-through and all that kind of stuff. But then you hear about these other banks I've never even heard of before, and they're doing tons of loans and a lot of real estate. What drives that? Because they're not the bank you go and drive up to and deposit a check. Like they're just they're in a suite somewhere and they're a bank. But
Right.
what's going on there?
Then we have a bank right now I'm thinking of in the Midwest.
Yeah.
Their source of capital, they do a lot of cash deposits for various firms. And so they're flush with cash, but they don't have to really actively market outside of their small market of where they're based.
Right.
But they do want deals nationwide. And so if you find those pockets, which we find those banks, because if we get a deal in a certain city or state, we're calling all the lenders around to say, hey, updating our programs. Our system, right? We track banks and who's lending on what. So we're always updating those contacts, updating their quotes. So as we come across them, we learn what they'll get aggressive on, what they like. And so we just send those deals to them.
So they could be in the Midwest, but they're lending all over the country.
Yeah.
Right.
Our Florida bank does a deal in Texas. We bring banks from all over on deals.
And do they do that just to diversify their loans around the country and not be in one area?
I don't know if it's that. Really, if you look at,
Or it's just a bigger pool of potential better deals if you're going.
it's
nationwide?
that. It's the quality of asset, right? If you're bringing 50% leverage credit tenants to a bank, they maybe don't see a lot of those locally, but they'll chase that out of their market. But it's kind of it's conflicting, right? Because a lot of these banks, per the guidelines, they want local customers. They want to show relationship. So it's sometimes conflicted, right? It's a catch-22 there because they want to chase the deal, but the client's not in their market. So it's finding back to the creativity thing, right? Hey, we'll give you the deposits, plus you can have the operating account for this client to flow through your bank to show relationship. And I always find that interesting. It's such a unique mindset to me because for me, getting an intro to a big client, whoever it may be, that's what I want, right? That's your goal, is just to talk to them.
Yeah.
A lot of these banks, you may have a client worth $50 million, $100 million. And they're like, oh, this is just a transaction. I'm like, that's such an interesting perspective because you got this rich dude, guy or gal, that has all this money that you could easily go after to build a relationship, but you already think there's no future business, which is baffling. And I've had small banks go, you know what? Thank you for that intro, because now we have a really good program for them. Shocking, right? And they want to have us do more for them. Like that should be the mindset, I would think.
I agree.
Yeah.
Especially right now, if they're not handing deposits by us or the borrower now, then they just have no interest, which is crazy because they still have the deposits that you could get later.
Right.
If you actually worked hard and established a good relationship with them.
Yeah.
And a client
work towards that.
Yeah. If I had a good bank that treated me well and always did what's right and had good terms, why would I not give them more money?
No, I couldn't agree more.
Yeah.
And that's made us so successful in life. We've never been the team, no matter where we've worked, whatever company, that's too good for a deal, right? So if a deal's $1 million, if a deal's $200 million, we don't put our noses up in the air. And some other firms we worked at before, a lot of guys will say, oh, it's not 20 million pass.
Well, the people doing $200 million deals probably did $2 million deals at one time, didn't
course,
they?
right.
Nobody, I know I started at 200 million, but I think most people,
Except for you, most people start
outside of
smaller.
me, So
No, they do. And what I found too is if you help them with the small deals, they give you the big deals.
Of course.
So
did y'all grow up wanting to be mortgage makers together? From
I definitely did not. No.
I just had posters of money on my wall when I was a kid. Just like someday I'm gonna lend. Yeah, medical, maybe medicine, until I realized I didn't like blood.
yeah.
That's usually a problem. And then I worked with the doctor for a while, and he's like, get out while you can. The insurance is terrible.
Yes.
So I'm like,
Quit touching all the instruments. Yeah.
it's not a toy.
So how did it happen? How did you decide I'm going to lend money from medical?
When I graduated, both of us actually. I grew up at Lake of the Ozarks, and so I was a boat captain in high school and college.
Like the TV show.
The
Ozark?
Ozark, yeah. Very different experience for us.
Right.
Did y'all
Less
have
dead
the
people and
floating
drugs.
church and heroin and the Bible thing?
I didn't see much of
Didn't
that.
see
no.
that.
Oh,
No.
okay.
I'm sure
I
it
thought
was
that was a
around.
true story.
It may have existed somewhere.
It might have been.
Like,
We had a floating pizza place.
we did.
What's that called?
I don't know.
Got
It went under though.
Not literally.
No, not literally. Yeah.
Nope, unintended.
lake
But it was
Lake Pond.
floating.
Yeah. It was
What's that
floating.
called? Anyway, but when I graduated, I wasn't sure what I wanted to do, but I realized that sales is the answer because I knew I'd outwork the guy next to me, and I don't want to make the same as someone else.
Right.
I want to be paid for my hard work.
Sure.
And so I got into this. One of the guys I'd worked with actually I drove a boat with, was in real estate financing here in Dallas. So I flew here and liked the industry and the space and never looked back. It's
So
been
where
great.
was your first lending job at? Where'd you land?
In Uptown, a little company called BMC.
BMC.
Yeah. Yep.
Yeah, I wasn't aware of it until Shawn started.
Yeah.
So he kind of introduced it to me. I joined him later, 2014, I believe.
I think it's right.
Yeah.
So how long were you at BMC before you went and started your own shop?
7 years, 6 years?
Yeah.
3. Yeah, for me, I moved to St. Louis to open an office there, and 08 hit. And so I'm like, what? You're giving away half
Great
your...
year to start
I
lending.
figured the market's hot. You want to strike now? But strategically, it was great. It was a great time. They were having issues from my perspective too, and people couldn't get in the office. And so for me, it made sense just to move on because it was all commissioned. So you're paying commission to a company. I didn't feel like the value was there, and
Sure.
I felt like I could do it, do it better. And so I took a lot of what I learned, and good and the bad, and started Capstone.
So how do you start that? How do you start Capstone? Did you have to go line up relationships to lend through? How does that work?
Luckily, we had a lot of them, right? 'Cause
Yeah.
I've been doing it for a while already.
Right. 7 years at BMC.
Right. So I had a lot of relationships already. And so it was, cultivating the lender relationships, finding new clients, right? Calling a lot of real estate agents and referral sources, and just smiling and dialing.
Yeah.
And then really also building a system, software, really having the foundation in place. And once you have that figured out, you can rinse and repeat and grow nationwide. So we had 6 offices coast to coast at the time.
Right.
And CBRE, we sold that to CBRE in 2017.
The software was key for you. Was that something you had at BMC? Or
They
was
had their own software, yeah. I built one from scratch because what I was doing is, at the time, I've been going after LoopNet to try and be their lender. And I saw every 6 months they had a new debt broker on there. It's like, well, there's clearly an inefficiency here. Like, we need to solve for this inefficiency. So I started talking to them about that, saying, hey, why is everyone leaving? And so I started calling all the contacts that were the lender for LoopNet. And it'd be a voicemail for someone that's full, they didn't speak English clearly, or you couldn't understand them. And so I'm like, okay, you got full voicemails. And then you go look at their website, and there may be experts on one product type, maybe small apartments. Like, well, you're getting all this stuff just bombarding you. How are you quantifying this massive information, right? And so I realized quickly that, hey, if I can build a software system to quantify this data and track it all, where all the clients go through a landing page and submit it to us, then I can quickly see if there's a deal or not, and then move it to whoever in the team can handle it. So I did that. And so at the time, they powered New York Times and Wall Street Journal's listings as well. So for
LoopNet did?
So for 13 years, we were the exclusive lender for LoopNet, New York Times, and Wall Street Journal for all their commercial listings. And we had them add a little next to each property. It's like get financing, a little button.
When you say commercial listings in the New York Times, is that like people like putting that in the paper, basically?
No, they have a separate section on those powering listings. They could go online like a LoopNet section and put listings on there with the loan amount pricing.
Within their on the New York Times
on that
page. Okay.
right.
They're usually more local to that market.
Right.
Or they would just be another source that, like LoopNet, I think, before CoStar bought them, just powered all these different websites through the listings. And so because of that relationship, we had that. And so we were getting 70 leads a day, 68, 70 leads a day. And I would say if you get 70, maybe 68 are junk.
It seems like if you were, obviously these groups before y'all were paying money to LoopNet to be their click lender, right?
Yeah.
It seems pretty elementary that you'd want to track those types of things. Do you just sometimes you're just like, what in the world is wrong with these people? Why would they?
Yeah, no one figured it out. I mean,
yeah.
no one for however many years and however many 20, 30 people never figured it out. So I
always wonder if they just didn't know what they're walking into.
Maybe.
As well. Right, they would give it to
Or maybe they
another
closed,
group and
2-3 deals a quarter, and it paid for it, more than paid for the advertise. I don't know.
They weren't closing enough because they were dropping it.
Right.
It was expensive. And so what we had done too at the time, we were able to get a right of first refusal because we took it over in our company in 2009, end of 2008, and the market was crap.
Yeah.
So we said, hey, we're going to do this. We're going to do it right. And I've got a software built, and we'll do this perfectly. We'll track it, and we'll give you updates and everything. But in exchange for that, if we're going to take this over, we want to write a first refusal because we can't build all this and have someone else try and just outbid later.
Yep.
And it was a great relationship for a long time. So, but that goes back to just in our industry, in life, right? Whatever you do,
right,
you got to find a creative way to differentiate yourself. And so we had to do it better, faster, stronger than the competitors. And I felt like we built a better mousetrap, really, is the play there. And it paid off because we sold it. So it literally paid off.
Y'all aren't the LoopNet click anymore. Yeah.
That was lost.
They got rid of that. So
LoopNet doesn't even have it anymore. No.
Nope.
Must have been too good of a revenue.
We're the
stream.
last and the best.
Yeah.
That's right.
No, I mean, you get different management and they go different routes, and I don't pretend to know internal workings of the company. I don't work there.
Yeah. Do y'all get today at y'all size? Do y'all still have leads coming in like from a source like that, or is it pretty much y'all built a database now large enough that y'all have plenty of clients to call on without inbound leads
Sure,
coming in.
sure. Yeah, I would say it depends on where you are kind of in your life cycle as a producer, right? If you're a junior, it's all outbound.
Right.
There's very, very little anyone calling you until you've proven yourself. We do have incredible referral sources kind of across the nation that Shawn's worked with or that I've worked with. Shawn longer than me, of course, that continue to use us because we've proven ourselves over and over again. So I would say that's majority of it. We are constantly working with new groups that are also doing the same. So especially right now, I think, and this is when you prove yourself to them that you can come through in really hard times. And so I think as this corrects, that will continue to flow even more so.
Yeah.
Yep.
Yeah, my experience is, I agree with that. My experience is different now because again, I've built a good reputation over the years of taking care of all these deals for clients. And I always say to the guys, you can do 100 deals great, and you mess up on one. They remember the bad one, not the good one.
For sure.
And so as much as obviously being perfect is impossible, but as much as you can be a perfectionist, our space requires it, right? Because you have deadlines, exchanges, you're dealing with tons of money, people's livelihoods. So you have to perform at all times. And if a deal goes sideways, which they do, hopefully you have a backup or a solution, which we usually do.
Yeah.
So for me, I mean, we get so many inbound calls now for me because clients I've worked with for years and performed for them over and over again. And the nice thing is too, they refer someone else. So I always say for me, it's not about the transaction, it's relationship. And we try and talk to the team that way.
For sure.
Because it's a small world. Commercial real estate's small.
Yeah.
So take care of your clients and they'll bring you other clients and just you build a community. And
Has do y'all do a lot of business inside Colliers?
some,
Yeah.
again, because of the background, we get deals from everywhere. I mean,
Right.
name a company, we probably work with them or have worked with them on a lot of transactions. And if we know the client well, the buyer, they'll tell whoever's listing a deal, hey, we want them doing the debt. So it's a lot of crossing. It's a small world.
Yeah.
And we see people from different companies. We were at different companies,
Yeah.
bounce around. So it's important to try and keep the relationships
Always.
if you can.
Yep.
True. So we got a few minutes left, but what are y'all? What's most active asset class y'all are lending on right now? Is one standing out from the other?
Yeah, multifamily and retail, those two.
Yeah.
We have so many portfolios right now. It's funny. Like I was telling you earlier, if a year ago we'd have had 20 term sheets in an hour on these, they're all credit tenant deals.
Yeah.
But it's clients getting dry powder ready for the market. It's a lot of refis.
Yeah. Retail is that's been surprising for people, hasn't it?
Yeah.
Because that was supposed to just totally go away,
Yeah.
but I
During
mean,
COVID, it got hit hard.
yeah,
But it's corrected.
people like to
Values have
go out of their
corrected, but
house.
yeah, they're back at it for sure. I would say a majority of them, of the tenants in that retail space,
Have the
doing
tenants
well.
changed some since COVID, or are we seeing?
I think there's always an ebb and flow, right? A natural flow to that. I think COVID fast forwarded a few industries that had some issues. It just brought them to light pretty quickly.
Like if you're buying a blender, you don't probably go retail anymore,
Right.
You just order that.
Amazon, that thing, yeah.
Yeah, Amazon effect's still in place. But yeah, I would say COVID, all it did was fast forward some of these industries that had flaws that maybe didn't fix them yet. But were
Right. That we're going out
they were
anyways.
going
and
to
it
fix
pushed
them,
it.
but they didn't have the money to. Either it forced them to fix it, or they just went under.
Yeah.
So
There's a lot of dog daycares out there now.
there are.
A lot of dog daycares.
Yeah,
Y'all's
and
dogs go to daycare?
if I had a dog, it would.
Yeah.
Yeah.
Once in a while.
Once in a while.
Gets his grooming, nails done. Yeah.
Dogs are living good.
They are.
Yeah, good time to be a dog.
Yeah. Really is.
Mine was laying around this morning on the floor, barking at nothing.
Nothing to
I don't know what
do.
they're- yeah.
Well, guys, thanks for coming on.
Yeah, thank you.
Y'all are
Yeah.
sounds like y'all are doing well even in this, tougher commercial real estate economy. But again, being in Dallas always helps. And how do people I love to send people y'all's way. One,
Thank you.
because I like you guys, but also y'all
Same.
when you refer somebody to someone, it's a reflection on you. And y'all always deliver with anybody that's ever gone y'all's way, so that's huge. How do people find y'all if they want to talk to y'all, or if they have a deal they want to shop y'all's way?
We have our team email address, GivensTeam@Colliers.com.
Okay.
So send an email to GIVENS team@Colliers.com, and
Come
we all
follow
get
us.
it.
Yep.
Yeah, and we'll post that as well.
Yeah. And then our team
Thank you.
website as well. You can see our faces. All of our numbers are there as well.
Will's MySpace page, whatever.
Yep. I still have it up.
Yeah.
Yep.
Well, that's
Brought it back.
Yeah.
I like MySpace. I like the music. You remember the music they played
was
on it
fantastic.
when it came on? That was great. Yeah.
It was like your music.
Yeah, it's
very similar.
Yeah. Yeah, it was Rock Band 3.
I was gonna say, was it your kids and you a Rock Band?
Yeah. Yeah,
good.
it's just we have a synthesizer.
He doesn't do the kitchen table in the morning. Yeah.
Making him.
You're doing it wrong.
In my room. Stop. Well, I
Well,
appreciate it.
yeah, absolutely. Why don't y'all come back and see us in a couple months, and let's see if all our
Yeah.
predictions are right.
We'll
do
see.
it. Thank you.
You got it, guys. Appreciate it. All right, this has been the Working Title Show with Zach Sams. We will see you next time.